Silver dropped as if someone had pressed a red button, and in practice they did. Not in mining, not in industry, not in consumption, in the margin system. If you want to understand why price collapsed without any real change in fundamentals, stay with me. I'm going to show you the mechanism that crashes prices fast and transfers wealth from the leveraged to the prepared. If you're new here, welcome. My name is AG, Ken AG. Here I don't make short-term calls, I don't do hype, and I don't sell promises. My focus is explaining the mechanism because when you understand the mechanism, the noise stops scaring you. If this kind of analysis helps you, subscribe to the channel, hit like, and comment below what you think is happening with silver right now. That helps the channel stay independent. Quick and necessary disclaimer. This content is educational and informational. It is not a buy or sell recommendation. Always do your own research. Now let's get to the facts. Today, quietly, COMEX raised margins for the 6th time in a short period. Let's look at the numbers. Silver, initial margin rose from 15% to 18%. High-risk profiles margin went up to 19.8%. Gold margin rose from 8% to 9%. Does that seem small? It isn't. Because in January 2026, COMEX did something even more important. It completely changed how margins are calculated. Before, margin was a fixed dollar amount. Example, $10,000 per contract. Now margin is a percentage of total contract value. That changes everything. Let me explain why this is such a massive shift because most people don't understand the implications. When margin is a fixed dollar amount, it stays constant regardless of what happens to the underlying price. Silver could be at $20 or $120, and if the exchange says you need $10,000 margin per contract, that's what you need. Your margin requirement doesn't change with price. But when margin becomes a percentage of contract value, everything changes. Because now as silver price rises, your margin requirement rises proportionally. Let me show you the math. A COMEX silver contract is 5,000 ounces. When silver was at $25, the contract value was $125,000. At 10% margin, you needed $12,500. But when silver hit $120, the contract value became $600,000. At 10% margin, you now need $60,000. Same percentage, but 4.8 times more cash required. That's the hidden mechanism. As price rises in a bull market, percentage-based margin requirements force traders to post exponentially more capital, not because their risk increased proportionally, but because the nominal value of the contract increased. This is how exchanges choke off speculation during parabolic moves. They don't ban trading. They just make it prohibitively expensive to hold leveraged positions. Let's simplify with a current example. Say a trader has a silver contract today worth around $350,000. Under the new rule, 18% margin equals about $63,000 in collateral. If it's a high-risk profile, nearly $70,000. Now think about the average trader. They came in leveraged. They were comfortable at 10 to 12%. They don't have another $11,000 or $15,000 sitting in cash. What happens? Margin call. And a margin call is not an invitation, it's an order. You have two options. Deposit cash immediately or have your position force closed. Most didn't have the cash. Result? Force selling. Let me walk you through the cascade step by step because this is critical to understanding what happened. Step 1. COMEX announces margin increase from 15 to 18%. Step 2. Traders who are holding positions with exactly 15% margin suddenly become undercapitalized. They're below the new requirement. Step 3. Brokers issue margin calls. You have 24 to 48 hours typically to meet the call. Step 2. Traders who were holding positions with exactly 15% margin suddenly become undercapitalized. They're below the new requirement. Step 3. Brokers issue margin calls. You have 24 to 48 hours typically to meet the call. Step 4. Traders scramble. Some deposit more cash, but many can't or won't. Maybe they're tapped out. Maybe they think it's not worth it. Maybe they're already underwater on the position. So they sell. Step 5. That selling pushes price down. Silver drops from 90 to 85 to 80. Step 6. As price drops, other traders who weren't initially margin called now hit their stop losses. Or they hit the point where their equity falls below maintenance margin. So they get margin called too. Step 7. More forced selling. Price drops further. Step 8, repeat. This is a self-reinforcing cycle. Each wave of selling triggers the next wave, and it continues until one of two things happens. Either price drops so much that it hits fundamental support, where physical buyers overwhelm paper sellers, or volatility compresses enough that maintenance margin requirements stabilize and the forced selling exhausts. That is exactly why price fell so hard over the last few days. Welcome to the new era of video creation with hedge. Simply type your script to get started. Now let me give you historical context, because this pattern isn't new. In 1980, when silver was in its parabolic Hunt Brothers rally, COMEX raised margins 5 times in 3 months. They went from 10% to eventually over 50%. That margin squeeze was one of the factors that broke the rally and forced liquidation. The Hunt brothers couldn't meet the new requirements. They got margin called. And when they tried to meet the calls by borrowing, when that failed, the positions were liquidated. Silver crashed from $50 to $10. But let me give you more detail about how that played out, because the parallels to today are striking. In late 1979, silver was around $10. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, along with some Saudi partners, had accumulated massive long positions in silver futures and physical. By January 1980, silver hit $50. That's a 500% move in months. Exchanges panicked. COMEX first raised margins in December '79, then again in January, then 3 more times by March. The final margin requirement hit $75,000 per contract on maintenance. That's the equivalent of requiring 75% margin in today's terms. Nobody could hold leveraged positions at that rate. The Hunts tried to meet the calls. They pledged oil properties. They borrowed against other assets, but the amounts were too large, billions of dollars in margin calls. On March 27, 1980, Silver Thursday, they defaulted. Batch Halsey Stewart Shields, their broker, took over the positions and liquidated. Silver crashed from $21 to $10.80 in a single day. That's a 50% drop. The entire market seized. Banks that had lent to the HUDs faced losses. The Fed had to intervene to prevent systemic crisis, all because of margin hikes. When exchanges want to break a parabolic move, when they want to flush leverage, they have the tool: margin requirements. It's legal. It's within their rules. And it works. Every single time. In 2011, when silver rallied from 26 to 49 in the first half of the year, CME raised silver margins 5 times in 9 days. That forced a correction. Silver dropped from 49 to 35. The fundamentals hadn't changed. Industrial demand was strong, supply was tight, but the margin increases forced leverage out, and that created a technical correction within a bull market. Let me give you the specific timeline. May 1st, 2011, margin at $14,000 per contract. May 2nd, raised to $16,000. May 5th, raised to $18,000. May 9th, raised to $21,000. May 11th, raised to $24,000. In just 9 trading days, margin increased 70%. Each hike triggered a wave of liquidation. Each wave pushed price lower. By the time it was done, silver had corrected 28% from the highs. But here's the critical point. That correction didn't end the bull market. Silver consolidated between 30 and 40 for months. Then in April 2011, after the correction, it tested the highs again. The fundamentals supported higher prices. The margin hikes just created a technical pause. Smart traders who understood the mechanism bought the dip. Those who panicked sold at the lows and missed the recovery. The pattern is always the same. Price rises parabolically, exchanges get nervous about systemic risk, they raise margins, leverage gets flushed, price corrects. Then after the correction, after the weak hands are gone, the bull market can resume, but the correction is brutal for anyone who was over-leveraged or didn't understand the mechanics. In India, on the MCX exchange, silver margins reached 25% today. That confused a lot of people online. Was it 20%? Was it 30%? Was this global manipulation? The exact number is not the point. The point is the whole world tightened leverage at the same time. And when that happens, small players get pushed out. Let me explain why exchanges do this because it's important to understand their perspective. Exchanges are risk managers. Their job is to ensure the integrity of the market and prevent defaults. When price moves violently, when volatility spikes, the risk of default increases. If a trader is long silver at 100 and it drops to 80, they've lost 20%. If they were leveraged 10 to 1, they've lost twice their initial capital. At that point, they might default. They might walk away from the position and leave the broker holding the loss. To prevent that, exchanges raise margins. They force traders to have more skin in the game. That reduces leverage. That reduces the probability of default. From the exchange's perspective, it's prudent risk management. But from the trader's perspective, it's forced liquidation at the worst possible time. Both perspectives are valid, but understanding the exchange's incentive helps you anticipate when margin hikes are coming. You need to understand one fundamental thing. Silver is traded in only two markets: physical market, bars, coins, real metal. You buy it, you own it, you store it. This moves on real supply and demand. Paper market, futures contracts, ETFs, derivatives. Here you don't buy silver, you buy a promise. And that promise uses 10 to 1 leverage or higher, meaning you control $350,000 with $35,000 or less. That market runs on margin. An exchange cannot create physical silver out of thin air, but it can raise margin, reduce liquidity, force liquidations, crush paper price, and that is exactly what happened. While paper dropped 30 to 35%, contracts were liquidated, traders were kicked out. The physical market did the opposite. But it can raise margin, reduce liquidity, force liquidations, crush paper price. And that is exactly what happened. While paper dropped 30 to 35%, contracts were liquidated, traders were kicked out. The physical market did the opposite. In Shanghai, premiums hit records. People were paying $40 plus over paper. Real metals simply vanished. Let me give you specific data because this is the smoking gun. On COMEX, silver quoted $78. In Shanghai physical market, silver traded at $115 to $120. That's a $40 premium. In India, premiums hit $35 to $40 over spot. Dealers were out of stock. Mints suspended sales. Wait times for delivery went to weeks or months. Let me break down what this looks like on the ground because numbers are abstract until you understand the reality. In Shanghai, if you walked into a bullion dealer last week, they'd quote you $110 to $115 for a kilo bar. Not 78, not 80, 115. And that's if they had stock. Many dealers were completely sold out. They take your order and tell you delivery in 4 to 6 weeks. That's unprecedented in normal markets. In India, the premiums were even more dramatic. Mumbai dealers were quoting 30,000 rupees per kilogram when the COMEX equivalent was 21,000. That's a 43% premium. And again, availability was the issue. Large buyers, jewelry manufacturers who need silver for production, they were scrambling. Some were offering premiums above the quoted prices just to secure supply. That's panic buying in physical while paper was crashing. In the United States, retail was similar. American Silver Eagles, 1-ounce coins from the U.S. Mint, were trading at $90 to $95 when spot was $78. That's a $17 premium on a 1-ounce coin. Normally, premiums are $2 to $4, so premiums quadrupled, and that's for small retail sizes. Try to buy a 1,000-ounce bar for immediate delivery, and you'd face even higher premiums or delays. The Perth Mint in Australia suspended retail sales entirely. Their website showed out of stock on all major products. The U.S. Mint reduced production and couldn't keep up with demand. Refiners were backed up. The physical supply chain was maxed out. And this was happening while paper price was collapsing 35%. That disconnect tells you everything you need to know about what's real and what's derivative. That tells you everything. If this was a fundamental demand collapse, if people actually didn't want silver anymore, you'd see premiums collapse. Physical would be abundant. Dealers would be offering discounts to move inventory. But the opposite happened. Paper crashed. Physical held firm. Premiums exploded. That's the signature of a paper liquidation event, not a fundamental breakdown. If this was a fundamental demand collapse, if people actually didn't want silver anymore, you'd see premiums collapse. Physical would be abundant. Dealers would be offering discounts to move inventory. But the opposite happened. Paper crashed. Physical held firm. Premiums exploded. That's the signature of a paper liquidation event, not a fundamental breakdown. If you're in paper, you are subject to rules that can change without warning. Margin goes up, your position gets closed, you lose control. You might be right about the long-term direction. You might understand the fundamentals perfectly, but if you're levered and margin requirements change, you can get wiped out before being proven right. If you focus on physical silver, no one calls you to deposit more money. No one liquidates your position. No one changes the rules of your game. You own the metal. It sits in your vault or your safe. The paper price can go to 70, to 50, to 30, but you still own the same number of ounces. And when paper reconverges to physical, when the dislocation closes, you benefit. Screen price is a derivative. It's derived from futures contracts, from ETF flows, from derivative positioning. Real price is what it costs to put metal in your hand. And right now, those are completely disconnected. That disconnect is opportunity. But only if you understand it. Only if you're positioned to take advantage. And positioning means owning physical or having cash to buy physical when paper dislocates. Let me give you tactical guidance based on this understanding. If you trade futures, if you use leverage, margin hikes are your enemy. You need to anticipate them. When price goes parabolic, when volatility spikes, exchanges will raise margins. That's predictable. So either reduce leverage preemptively or keep excess capital in your account so you can meet margin calls without being forced to liquidate. Here's a specific framework. If you're trading futures, never use more than 3-to-1 leverage even when the exchange allows 10-to-1. Why? Because if margin requirements double, you have breathing room. If you're at 3-to-1 and margins go from 15% to 30%, you can meet the call. But if you're at 10-to-1 and margins double, you're toast. You get liquidated. Second rule, keep at least 25% of your trading capital in cash reserves specifically for margin calls. Don't deploy everything. If you have $100,000 to trade, only put $75,000 into positions. Keep $25,000 liquid. That reserve is your insurance against forced liquidation. It lets you ride out volatility without selling at the worst prices. Third rule, use stops, but use them intelligently. Don't set stops at obvious technical levels where everyone else has stops. That's where exchanges and market makers hunt stops. Set them at levels that represent actual breakdown of your thesis. For silver, maybe that's below $70, where physical buyers become overwhelming. Not at 82, where every chartist has a stop. If you own ETFs like SLV, you're not subject to margin calls. But you are subject to NAV dislocations. During extreme volatility, ETF shares can trade at significant premiums or discounts to net asset value. In a crash, SLV might trade below NAV as panic sellers overwhelm arbitrage. That creates opportunity to buy cheap. But it also means your shares might be worth less than the underlying metal temporarily. Specifically, watch the SLV Premium Discount Indicator. If SLV is trading at a 3 to 5% discount to NAV during a crash, that's opportunity. Authorized participants will eventually arbitrage that gap by buying cheap shares and redeeming them for metal. That arbitrage closes the discount. But it takes time, sometimes days. So if you're nimble, you can buy the discount and profit when it closes. Authorized participants will eventually arbitrage that gap by buying cheap shares and redeeming them for metal. That arbitrage closes the discount. But it takes time, sometimes days. So if you're nimble, you can buy the discount and profit when it closes. If you own physical, This is validation. The fact that physical held firm while paper crashed proves the thesis. Paper is manipulated. Physical is real. Paper has counterparty risk. Physical doesn't. The strategy is to hold and potentially add if you have capital, because these dislocations eventually close. And when they do, physical holders benefit. Here's how to think about adding to physical positions during paper crashes. Don't try to time the bottom. That's impossible. Instead, think in tranches. If you have capital to deploy, divide it into 3 or 4 parts. Buy one part immediately when paper crashes. Buy another part if it drops another 10%. Buy the third part if it drops again. And keep the final part for true capitulation. That way you average better prices and you don't miss the bottom by waiting. If you're sitting in cash wondering whether to enter, the framework is simple. Don't try to catch bottoms. Scale in. If silver is between 70 and 80, that's a range. Buy some at 78, more at 75, more at 72. Average a good price. And buy physical or unleveraged ETF shares, not futures, because leverage is what destroys you in these environments. Let me give you a specific example. Say you have $50,000 to invest in silver. Don't put all $50,000 in at once. And definitely don't put it into leveraged futures. Here's a better approach. Buy $15,000 in physical silver immediately. That locks in exposure. You own metal. Nobody can take it. Then put $15,000 into SLV or another unleveraged ETF. That gives you liquidity if you need to exit quickly. Keep $20,000 in cash. Now watch the market. If silver drops to 70, deploy half your cash. Buy more physical or more SLV. If it drops to 60, deploy the other half. That way you average down without running out of capital. And you avoid the regret of going all in at one price only to watch it drop further. This approach isn't sexy. It's not exciting, but it works. It lets you participate in the bull case while managing the risk of being too early. Understanding this changes everything. How you react to volatility. Welcome to the new era of video creation with hedge. Simply type your script to get started. That's the game. Not theory, not conspiracy, structure. Markets are designed to transfer wealth from the impatient to the patient, from the leveraged to the unleveraged, from those who don't understand structure to those who do. And margin hikes are one of the primary mechanisms for that transfer. If this video helped you, subscribe, and leave a comment saying whether you think this margin squeeze is over or just getting started. Because that's the question that matters. If margins stabilize here, if we don't get another hike, forced selling should exhaust and price can stabilize. But if margins go higher, if COMEX or MCX tighten further, we could see another leg down before bottoming. Thanks for watching. See you in the next one.